Hello, everyone. Felipe here. Happy Monday. Hope everyone is doing good. Had a great weekend. So, as you know, I'm here to keep you up to date with current market news and teachings. This is in no way, shape, or form financial or investment advice. This is for entertainment and educational purposes only. So, in this video, I'll be doing a financial vehicle breakdown, specifically in the variable annuity space. Basically, just so you know what's out there available to you in the market. I love studying all these different investment vehicles and their intricacies and how they work. So I'll go ahead and jump right into it with some slides that I got, and let's go. So variable annuities, basically, right? So variable annuity assets. So variable annuities are typically in life insurance company products. They're equivalent to pensions, which pensions are non-existing anymore. But basically, variable annuities. I'm going to be talking about variable and in a kind of way index annuities in this video. So variable annuity assets are held in separate accounts, which are segregated from other assets of the insurance company. This leaves insurance policyholders and general creditors facing the financial risk. So insurance companies have two kind of accounts: separate account and a general account. Separate account basically means the person, in this case, the owner of the variable annuity, is taking the risk at the market. However, there are certain things that the insurance company provides to protect against market loss, or mitigate market loss. So separate account of insurance company is a different account that insurance companies hold that they cannot commingle with the general account. Separate account is for variable items. Variable, fancy word for stock market. General account is the account where index items or index investment vehicles are held within. Basically, some terms to go over. So accumulation period for annuities is basically the period of the agreements where the investment within the vehicle is growing at whatever the rate of return is for the market in the case of a variable annuity, or in the case of the sub account that variable annuity is tied to, because there's different accounts that can be chosen, right? So accumulation period, as I said, is the period of the agreements. It could be 5 years, 7 years, 10 years, and so forth, that the money or the investment is growing at the rate of return of the market. When payments begin on a variable annuity, the annuitant is credited with a specific number of annuity units. This number of units will remain fixed. The annuitant's monthly payment will vary according to the value of the securities represented in each unit. Basically, which sub accounts are chosen and the performance of those sub accounts and whatever stocks or companies or sectors they have in them, that performance is going to basically determine the annuity unit's value. And variable annuities in general, they can be 1035 exchanged. Well, you can 1035 exchange, which I'll go into it in a little bit, from life insurance products to annuity products, but not the other way around. And then you can roll over from IRAs, 401ks, and similar vehicles into annuity products without incurring a tax penalty. 1035 exchange, it's like the real estate 1031 exchange, but for insurance products. So basically, provision in the tax code permitting direct transfer of cash value in certain insurance products without incurring tax liability, since no check is issued to the client. So the check never touches the client's hand. It goes from insurance company to the other product, or from insurance company to insurance company. Therefore, it doesn't create a taxable event. Which of the following exchanges are permissible? A non-qualified annuity for a non-qualified annuity, yes. So annuities can be rolled over into annuities. A life insurance policy for a life insurance policy. So life insurance policies such as IULs can be 1035 exchange, or whole life, universal life, so forth can be exchanged for one another without a tax liability. Life insurance policy for a non-qualified annuity. Yes, so life insurance policies can be 1035 exchanged to annuities. Of course, it has to be a cash value insurance policy. An annuity product to a life insurance product. No, cannot, because some life insurance cash value insurance products are tax advantage. Annuities are tax deferred. And since they're different tax families, that cannot occur. Justification for transfer: circumstances or investment goals change dissatisfied with the insurance company. There has to be an actual reason for the 1035 exchange, or some sort of benefit to the client in order for that to be appropriate. So once variable annuities have been annuitized, changes are not permitted. 1035 exchange is switching from one annuity to another during accumulation period. Annuitization basically occurs when a policy owner exchanges a lump sum value of his or her annuity for a lifetime income stream. That's where the pension, hence the comparison or to the pension comes in. And this choice cannot be reversed. With an income rider, however, the decision can usually be reversed. So there's different stipulations and riders that can be added to these that will be able to it's gonna depend on how the payout occurs and certain benefits and so forth that come along with riders. With riders, it's just a fancy word of an agreement or form that's added on to the annuity that has a certain benefit that is utilized on annuitization. So a fancy word for annuitization, or the term, is after the accumulation period, the period of the agreement where the annuity has grown, hopefully at the rate of return of the market, and that's credited into the account. That person can now annuitize the annuity and begin getting income from that annuity in a pension-like way. Settlement options, this is kind of where the annuities provide different settlement options, and all of these have different payouts or different little benefits to them, and only one of these can be chosen per annuity agreement. So straight life or life only annuity, this option gives the annuitant the highest periodic payments but carries the most risk. The annuity receives payment as long as he or she lives. Upon the annuitant's death, all payments end. Therefore, if the annuitant dies after receiving only one payment, no other payment will be made. This payout option provides the smallest promise, the greatest risk to the annuitant, and therefore is the least expensive, provides the largest monthly checks. So this is a beautiful example of what I like to say. Annuities are protection against living too long, whereas life insurance is protection against not living too long and passing away too early. So it's like the two ends of the spectrum. Hedging against living too long and the fear of outliving your income. Annuity basically protects you against that. And then, of course, life insurance protects you against, God forbid, an unforeseeable event occurs, someone passes away or becomes disabled or something along those lines, or sick. That's protection against that. So it's literally protection against two sides of the coin. God forbid, passing away too early, or, which a lot of people fear most, is running out of money and living too long, which there's where the annuity comes into and provides that security. Life annuity with certain fixed period. This method, period payment are made to the annuitant for a specific number of years, usually 10 or 15. If the annuitant dies before the end of the period, the remaining payments due will be made in a lump sum or installments to the named beneficiaries. For example, if the annuitant has a 10-year period certain annuity and dies after receiving payments for 6 years, the beneficiary will receive the remaining 4 years of payments. However, if the annuitant dies after receiving payments for 13 years from a 10-year period certain option, no further payments will be made because the company is obligated to pay only up to the annuitant's death if he or she outlives a period certain of the contract. So this is more kind of like a death benefit add-on to the annuity in terms of a settlement option. And then unit refund life annuity. This option provides periodic payments during the annuitant's life. If the annuitant dies prior to receiving an amount equal to the value of the annuity units, the remaining portion would be paid in a lump sum or installments to the beneficiaries. And then joint and last survivor life annuity. With this option, payments are made to 2 people. If one annuitant dies, payments continue to be made to the surviving annuitant. All payments cease when the remaining person dies. This payout option provides the largest promise, least risk to the annuitant, and consequently is the most expensive. Provides the smallest monthly check. Combination annuity. A combination annuity is a good hedge against inflation and deflation because a portion of the contract pays fixed interest, while the remaining portion could be placed in a variable annuity, which offers inflation protection. So you can kind of get an idea. These different settlement options have different benefits to them, and only one can be chosen per annuity agreement. So you can kind of see here, straight life provides the largest monthly check upon annuitization, whereas joints and last survivor life annuity provides the smallest monthly check. However, two people are added onto the agreement, such as spouses and so forth. So variable annuity accounts, and this is kind of just to break, I'm going deep into the stuff. So by the time I'm done with this, you guys are going to be like annuity experts, hopefully. And so accumulation units equals basically account measures that determine an annuitant's interest in the separate account. Annuitized, so accumulation units is annuity units. A unity unit equals the measure, the accounting measure that determines the amounts payout each period. And then the separate account, right? I was kind of going into this. Life insurance companies have 2 different kinds of accounts. They have a general account, they have a separate account. Assets in separate accounts cannot be commingled with assets in general accounts or assets in other mutual funds and fund families. The general account is basically fundamentally invested in long-term debt securities with the primary objective of providing a stable return to fund the guarantees made by the insurance company on its fixed insurance and annuity products, and index products, which are a hybrid of fixed and variable, or funds are within the general account. General accounts typically, I believe, I forget these numbers, but something along the lines of 90% of the general accounts funds are invested in treasuries, and then which is their state's long-term debt instruments, so treasuries, and then the rest is actually used to purchase option calls, and that's where the insurance company makes their big bang. They have very sophisticated divisions of investors that are highly specialized mathematicians. In the options world, options, if you're not familiar with it, are very complex derivatives, investments, vehicles, which you can more place on the speculation spectrum of things because they're very complicated vehicles. Accumulation units. Okay, what the hell is this, right? So accumulation units during the time During the time the owner is depositing money into a contract, the annuities valuation is expressed in an increasing number of accumulation units. In immediate, and this is for immediate annuities, which is an option. Someone lump sums a large sum of money into an annuity agreement and then decides they want to start getting immediate payouts to themselves in terms of subsequent paychecks, right? That is an option. So note that accumulation units only apply to deferred annuities. Deferred annuities is basically an agreement between the annuity owner and the insurance company for X amount of years. Within that X amount of years, certain interest rate returns enter that annuity agreement, and at the end of the period, annuitization begins. So accumulation units are only applied to deferred annuities. Immediate annuities do not have accumulation units because payments begin immediately. The value of each accumulation unit is directly related to the performance of the separate account. Separate account, again, is invested in the variable market. Variable market is just a fancy word for the stock market. As the value of the separate account increases or decreases, the value of each accumulation unit increases or decreases in proportion to the number of total units issued in the separate account. Accumulation units are purchased in a separate account at net asset value. So they function kind of in a way like mutual funds. Mutual funds actually open-ended mutual funds are purchased in net asset value because they don't actually trade on the market. They're purchased directly from the actual mutual fund. The annuities are similar in that sense. In this case, accumulation units are purchased at the separate accounts net asset value. After deducting any sales charge or other fees, new accumulation units are purchased using forward pricing in the same manner as mutual fund shares are acquired. This is where basically a lot of people compare annuities to a mutual fund with a insurance wrapper. That is a term that's used sometimes to compare annuities. However, they do have added additional benefits that I'm not a fan of mutual funds. And annuities are, I would say, typically managed by better managers because they come as long as a reputable, powerful, strong, financially healthy insurance company is chosen, right? After deducting any sales charge or other fees, new accumulation units are purchased using forward pricing in the same manner as mutual fund shares are acquired. An annuitant interest in the separate account is determined multiplying a number of accumulation units owned by the value of each accumulation unit. For example, an annuitant with 1,000 accumulation units valued at $6 per unit would have an interest in the separate account valued at $6,000. That's 6 times 1,000. Annuity units, which is different from, it's related to accumulation units. So the annuity period begins at the conclusion of the accumulation period. That's basically annuitization. That's when annuitization begins. The account measured used in the determination of the payments amounts to the annuitant during the payout or annuity period is referred to as an annuity unit. At the beginning of the annuity period, annuitization, the annuitant has 2 choices. One is to withdraw the value of the accumulation unit in a lump sum. So that's whether to get it all in a lump sum, or the second choice is to purchase annuity units with the accumulation units so that the period payments begin. And that's where potentially the guaranteed paycheck for life comes in, right? The value of these annuity units are dependent on the assumed interest rate, which is abbreviated AIR, AIR. So use the following procedures to convert accumulation units into annuity units. 1, calculate the annuitant's interest in the separate account by multiplying the number of accumulation units and the current value per unit. Calculate the first month's payments. For example, if the annuity contract is worth $100,000 and the accrual rate is $5 per 1,000 in the account, the first monthly payment is $500. 100 units, 1,000 times $5 per unit. Calculate the value of the future payment. This is based on the value of each annuity unit. For this example, assume that each annuity unit is worth $2.50 at the time of the first monthly payment. In order for the annuitants to receive $500, 200 annuity units must be liquidated. 500 divided by 250 equals 500 divided by $2.50 per annuity unit equals 200 annuity units. At this time, the number of annuity units is fixed. Each future monthly payment will be the redemption value of 200 annuity units. So assume interest rate, which is the air, which is then directly tied to what is paid out or what is the actual value of the annuity unit, which the higher the assumed interest rate, the greater the payout. The lower the assumed interest rate, the lesser the payout on that check, and it varies, right? The investment portfolio of the variable annuity is assigned an assumed interest rate. The rate is not guaranteed, it is merely a reference. The assumed interest rate is part of the annuity contract and is used to calculate the amount of each annuity payment over time. Even though the number of annuity units is established, the value of each unit will fluctuate in direct relation to the performance of the separate account and the heir. Future payments may be more or less or the same as the preceding payments, so it fluctuates. In general terms, and simplifying this concept, the separate account investment performance were exactly equal to the heir, the next monthly payment would be exactly equal to the preceding month's payment. If the performance were greater than the heir assumed interest rate, the next payment would be higher. Finally, if the separate account performance is lower than the heir, the next payment would be lower. No, performance rate is compared to heir percentage, but payment is compared to the previous month's amount of dollars. For example, assume that the heir is established at 5%. The reference is 5%. If the performance of the separate account of the following month is exactly 5%, the next monthly payment will be $500. If the performance is 3%, 2% below the heir, the next payment will be decreased by 2%. If the performance is 8%, the next payment will increase by 3%. The increase above the heir. There's a lot going on here, right? But kind of like what I said, the reference would be 5% of the heir, which is used as a measurement. And then if the actual performance of the heir is higher, then the next check is bigger, and if it's lower, the next check is lower, and if it's equal, it's equal, or the same as the last month. So here, basically, mortality guarantee. So the annuity company guarantees that it will make payments as long as the annuitant lives through a mortality guarantee. The insurance company deducts the mortality expense risk fee from the separate account to protect itself against an annuitant outliving their expected mortality. And here's where they have basically death benefits as well. So annuity contracts also have a provision for death benefit in the event that the contract owner dies during the accumulation period. The beneficiary will then receive the greater of the gross payments made into the contract or the accumulated value at the time of the owner's death. Some of this stuff I'm kind of basically going to come back to a little later, but surrender value. An annuitant can be terminated anytime during the accumulation period for its surrender value, which is the current value of the assets held in the separate account less any surrender charges. Contracts with high and or long-term surrender charges may be suitable for older, may not be suitable for older investors. These charges should be factored when considering a 1035 exchange. No termination, either whole or in part, can occur once annuity payments have begun. So once annuitization has begun, just fancy word for saying someone's receiving payments or income from that annuity after the accumulation period. Exchange privileges. This goes into the 1035 exchange limitations. So a life insurance contract to another life insurance contract, allowable. A life insurance contract to annuity, allowable. An endowment contract to annuity contract, allowable. An annuity contract to annuity contract, allowable. So an annuity contract cannot be exchanged for an insurance contract. So also into this falls pensions. Actual pensions can be rolled over to annuities. Also traditional IRAs, individual retirement accounts, 401ks, 457s, any similar vehicle along those lines can be rolled over to annuity products or investments without incurring a tax penalty or any taxable liability, because they're same tax family, tax deferred, right? And then basically consideration if for someone suitable for an annuity in general, basically. So the things to consider: the potential surrender period, surrender charges, potential tax penalty if the customer sells or redeems deferred variable annuities before reaching age 59 and a half. So they do have that similar restriction to traditional IRAs. They can't be accessed without a 10% IRS penalty until 59 and a half. Products fees such as mortality and expense fees, investment advisory fees, premium taxes, potential charges for the features or riders, and market and investment risk of the contract. Market and investment risk only applies for variable annuities because index annuities are guaranteed to a certain extent, and fixed annuities are just fixed. They have a fixed rate of return. Bonus production. Some certain variable annuity products may offer extra first year interest credits or bonus to attract sales. For example, some insurance companies offer a bonus upfront for a rollover from a IRA to an annuity to incentivize someone to do the rollover. For example, it can be 20%. It depends on what the insurance company sets. It could be 20% on initial rollover of the sum of the amount that's rolled over from the IRA. So let's say the person has 100K in their IRA or their 401k, they roll it over to the annuity. The annuity insurance company is offering a 20% rollover bonus. That individual that rolls their 401k into the annuity just made 20% on that 100 grand. They made $20,000 on that rollover. So some insurance companies actually do this, and the bonuses range depending on the insurance company. Something that I wanted to go into, or let me see. Well, let me just finish with this. So the three kinds of annuities: fixed, index, variable. Fixed are within the insurance company's general account, not at risk of the market. Fixed payments, so fixed rate of return, guarantees a minimum rate of return. Insurance company assumes the risk, vulnerable to inflation because fixed vehicles are usually less interest bearing. Index, hybrid of the two. That's why it's in the middle. It's a hybrid of fixed, hybrid of the variable. It's a combination of the two. Index annuities funds are within the general account of the insurance company, which is separate from the separate account. They provide payments based off of fixed or index rate of return. They can be tied to certain indexes such as the S&P 500 and other indices depending on the insurance provider, such as NASDAQ and so forth. Returns guaranteed a minimum rate of return, so you're basically guaranteed not to lose risk. Invest in insurance company again assumes the risk and less vulnerable to inflation because they're usually pegged to an index that usually performs a lot better than fixed rate of return. Variable, it's in the separate account. Separate account is basically just means your money or your investments invested in the stock market. So it's that you're the one assuming the risk as the investor or the client. Provides variable payments based on separate account performance. Provides no guarantee rate of return. Annuitant assumes all investment risk, resistant to inflation, because typically the stock market is a good stocks perform well during inflationary periods. And this is just good stuff to know. Non-qualified retirement plans, because annuities are considered non-qualified. So a non-qualified retirement plan is a type of a benefit plan that does not meet the IRS or ERISA requirements for favorable tax treatment or deduction and contribution. This type of plan does not need to be filed with the IRS and may discriminate in selecting plan participants. In other words, the employer can reward the highly compensated or selected employees without having to do the same for all employees. So qualified compared to non-qualified. IRS approval required for qualified, not required for non-qualified. Discrimination can not occur in qualified accounts where it can occur in non-qualified accounts. Contributions tax deductible. Qualified accounts not tax deductible in non-qualified accounts. Accumulation tax deferred on both. Withdrawals all taxed on qualified, and then on non-qualified, tax on portions above the cost basis. So that is breaking some of that stuff down. So some stuff that I wanted to kind of add to this in terms of additional information that I've just come across through readings and stuff. So the cool thing about annuities also is they're immune from divorce, they're immune from probate, and they're immune from bankruptcy. A lot of these variable annuities offer buffers, which is basically a term that is this. Buffers provide downside protection by protecting your account from the first loss up to a defined percentage. Typically, the first 5 to 20% of the losses are protected, and that hit is taken by the insurance company instead of by the actual annuity owner. The higher the protection level, the lower the cap would be. So in terms of receiving that buffer, the insurance company caps your rate of return at a certain rate of return, and that's how they're able to provide that buffer. Some of these annuities have sub-accounts that are invested in money markets. It's an option, right? I don't know why you would choose a money market, but some people are very conservative, and that makes sense to them, right? And in being conservative, money market is pretty conservative vehicle, I would say, right? However, I've across my readings, I found this interesting and just something I want to share. So I read this, or I came across this in Ray Dalio's book. I forget the name of the book, The Big Coming, or the World Change Order, one of those. So and this is specific to money market funds. They're not 100%, they've never not ever had any issues, right? So in approximately August 1st, 2008, money market funds, the main holders of asset-backed commercial paper. Commercial paper is basically short-term how do I explain it? Commercial paper is basically issued between corporations or companies with high credibility. It's basically IOUs with short-term payback periods, usually 290 days, I believe, are the maximum. So in August 1st, 2008, money market funds, the main holders of asset-backed commercial paper saw hits to their asset values and required assistance from their sponsors, banks, and fund families in order to avoid breaking the buck. Breaking the buck is a term which means this. By breaking the buck, I mean falling in value below amounts deposited, which is sometimes something depositors assumed would never happen, but did. So people never assume that money markets are always safe and nothing can ever happen to a money market. But in August 1st, 2008, this new term came to life called breaking the buck, which meant that the value of the amounts deposited within money market funds went below. And that had never happened before. It was the first time. And then I found this super interesting information to know. It's rare, but it can occur, right? Breaking the buck in case you want to see what that is exactly. So here I'm just going to go into some of Transamerica's B share variable annuities and other versions of this. There's one that I find very interesting, but I'm not going to be looking at it in this video. Maybe I'll do it in another video. So Transamerica B share variable annuity. What is this? So I'm gonna go through this really quickly. So product highlight, it has a 7-year surrender charge schedule, means it's an agreement between the individual and the insurance company for 7-year agreements of an annuity, right? And in this case, a variable annuity. So surrender charge schedule. How these work is, since it's a 7-year agreement, the investor or the annuitant owner has his funds in the insurance company for that time frame, right? Until he eventually decides to annuitize and start generating income from that annuity, right? Where that annuity is paying him off. So in this case, there are penalties, contingent deferred sales charges, and these decrease for every year the agreement is held, right? So on the first year, there's an 8% deferred sales charge. On the second year, 8%, third year, 7%, fourth year, 6%, 5-year, 5%, 6th year, 4%, 7th year, 3%, and any year thereon after, 0%. So death benefit options has fees assessed daily and is a percentage of the sub-account's policy value, which is the return of premium. Has a fee of 1.30. Annual step-ups have a fee of 1.50. A policy value death benefit has a fee of 1.150. Transamerica Principal Optimizer is it's one of the versions. Living benefit fee may increase. So the fee is 1.35. And then here we have the Income Edge, which is a different version. Income Edge 1.2. Living benefit fee may increase. The fee is 1.45 for single life and 1.55% for joint life. Additional options based on a year since the premium payment. So liquidity rider basically says the insurance company relinquishes any contingent deferred sales charges earlier with this specific rider. This rider has an additional fee to it, which is a fee of 0.50%. So basically, annual fees assessed daily for the first 4 years of the policy and is a percentage of the sub-account policy value. So here you can basically see from year 5, there is no contingent deferred sales charge, or basically you have the individual has access to the full annuity a lot sooner for longer contracts. So withdrawals without surrender charges, 10% of total premium payment each policy year. So let's say someone rolls over 100 grand into the annuity, they can access 10% of that annuity each year. So $10,000 without any penalties. Annual service annual service charge, lesser of $35 per policy year, or 2% of the policy value. The company has the right. Always look at the footnotes of these things, which is basically here. The company has the right to change the annual service charge up to a maximum of $50. It may be waived with net premium policy or policy value of $100,000 or more. So if the policy value is $100,000 or more, it may be waived. All guarantees, including optional benefits, are based on the claims paying ability of the insurance company. Again, this is just basically saying, hey, make sure the insurance company you have your annuity with is a strong financial institution with great reputation, has been around a long time. Otherwise, if they're a sketchy company, they go bankrupt, you have no annuity. The annuity disappeared, right? Because the company went bankrupt. Who's gonna be able to basically the annuity doesn't exist anymore, right? Transamerica Income Edge 1.2 is just a different version of it. Optional living benefit, straightforward, flexible, and cost efficient way to create income for life. So it's the more cost efficient one out of the group in this case. Very similar to the one above. And the only different, I guess, would be the annual fee, single joints or life, which I believe is about the same, 1.45% for single life, 1.55 for joint life. And then withdrawal percentages are based on the younger of the spouse when the spouse. So the living benefits are structured as joint life. The withdrawal percentages are based on the younger of the spouses when withdrawals begin. So similar to the one above, the only difference is that's a more cost efficient one. And then this is another version, Principal Optimizer. Basically, this is more of a conservative one. Confidence to remain invested no matter what happens in the market. So the annual fee is 1.35% for single and joint. So single and joint has the same fee in this case. Guaranteed minimum accumulation benefit guarantees the policy value would be at least as great as the guaranteed future value or on the guaranteed future value date. Annual option reset features, options to reset and guarantee future values and guaranteed future values date, which includes restarting the benefit waiting period on each living benefits anniversary. Annual optional reset is required to lock in earnings growth. So protection levels and guaranteed future values. That's what makes this one attractive, I guess. So 7-year waiting period, 100% initial, 80% minimum. 10-year waiting period, 110% initial, 80% minimum. This is basically the guaranteed future value. The guaranteed future value is the policy value multiplied by the protection level percentage at issue after the living benefit date. The guaranteed future value is increased by the percentage of subsequent premium payments multiplied by the protection level percentage and reduced for adjusting withdrawals. The guaranteed value, future value date is the policy value is guaranteed to be at least as great as the guaranteed future value. The protection level percentage is the amount of the future value of the account that is guaranteed, which will not be lower than the minimum stated above. So guaranteed future value premium vesting. And here where we go into that. So the percentage of subsequent premiums payments that are added to the guaranteed future value. So for a 7-year, basically waiting period, 7-year annuity agreement. First year is 100%, second year 90%, and this is the guarantee. Year 3, 80%, and then you kind of see here, year 7, basically, that's when someone either starts annuitization or so forth. So that would be 0%. 10-year waiting period, you kind of see here, year 1, 100%. All the way to year 9 is 50%, and then year 10, 0%. Withdrawals, guaranteed minimum withdrawal benefit. Withdrawals up to the living benefit withdrawal amount can be taken each year until the later of the annuitant's or annuitant's spouse death in the joint life option election. Again, this is kind of like the above. If the living benefit is structured as a joint life, the withdrawal percentage are based on the younger of the annuitant or the annuitant's spouse when the withdrawal begins. Your client should not purchase this living benefit without first obtaining the applicable rate sheet perspective. Yeah, you always want to look at the perspectives. Perspectives is a huge document with all the information on any one of these specific products, and every information's in there. So these are basically just some footnotes. Each waiting period will be defined. Will have a defined initial protection level percentage and minimum protection level protection level percentage. The PLP is the amount of the future value in the account that is guaranteed. Here's basically the investment options. There's a lot going on here, whole lot. So our options seek to limit downside risk and volatility in an effort to protect your client from extreme losses and give them confidence to stay invested through the market's inevitable ups and downs. Investment options from well-known money managers to ensure your clients have a wide array of choices. And this is basically the Income Edge 1.2 and the Transamerica Principal Optimizer. 75% of initial and additional premium payments may be allocated among any of the flexible and select investment options, and then in which this is flexible and selected investment options. Stable accounts, 25% of initial and additional investments will be automatically allocated to stable accounts. The guaranteed minimum interest rate of the stable accounts is 0.25. Transfers to and from stable accounts are not permitted. Stable accounts is fixed account option that is only available if the living benefit is elected. 75% of the funds go to flexible and selected investment options, and then 25% of stable accounts. Basically what this is saying. There's a whole bunch of funds in here to kind of choose from. I don't know the intricacies of all of these. There's a lot of them, but you can just basically Google the name of any of these and you can kind of see what's within these portfolios. For most of them, I would hope, right? So value, I would assume value investing or some sort of value fund where basically the money manager is purchasing stocks or companies that are out of favor or have good valuations, right? So buying at a cheaper, buying under the dollar, so to say. Mid cap seems more of a, so that would be the AB relative value portfolio. I'm not going to go through all of this because that'll take forever. Fidelity VIP mid cap portfolio seems like they're potentially in mid cap stocks. Mid cap stocks is more of an aggressive strategy. And then you kind of see here mid cap growth, mid cap value. So maybe mid cap stocks that are out of favor, mid cap growth, aggressive. S&P 500 index, you got the S&P in here. Small mid cap value seems pretty aggressive. Vanguard mid cap index portfolio, so there's a lot of aggressive portfolios here. Consumer staples, this is more conservative. Energy portfolio, so someone can choose if they feel they want that protection against inflation. Typically energy performs well during inflationary period. Healthcare portfolio, that sounds very, very, and this is Fidelity VIP healthcare portfolio, sounds very aggressive. Usually healthcare and biotech is very aggressive. Technology portfolio, utilities, technology, of course, would be considered more aggressive. Fidelity VIP utility portfolio, that's way more conservative because typically utilities is more of a conservative investment approach. Asset allocation, so you have all the kinds of different strategies in here. Asset allocation is balanced portfolio. Balanced portfolio is basically certain allocation to stocks, certain allocation to bonds, right? And other things. So a diversification balance between a portfolio that's invested in stocks, bonds, and potentially other things. TA 60-40 allocation, I'm guessing that is a 60% stocks, 40% bond allocation. Vanguard VIF balanced portfolio, again, just balanced portfolio. So you kind of see here, there's a lot. And when they say array of things to choose, they didn't lie. There's a lot to choose from, which can be kind of overwhelming, right? But these are all sub accounts that are available to these products. So TA America funds manage risk balance, so balance conservative. Kind of get the idea. International would be international. So JP Morgan International moderate growth. So invested outside of the US market. Balance ETF, conservative ETF, growth ETF. So we have ETFs in here. forget what the abbreviation stands for. I believe is affected traded funds, something along those lines. Basically just a basket of stocks. And here, alternative fixed income, TA, BlackRock real estate securities. This seems more like maybe mortgage-backed securities or investments in real estate related stocks. Bond fixed income, TA, Aegon high yield bond. Aegon is Transamerica's parent. High yielding bonds typically are riskier bonds. They yield higher rate of returns. Investment, so fixed income, TA, Aegon US government securities. So there's treasuries, TA, BlackRock government money market. That's money market. That's kind of why I went into the whole breaking the buck term. General account, basically just Transamerica's stable account. So there's a little bit more here, but I think I'll stop there because this is getting pretty long. With that being said, I'll leave you guys with a quote. Gambling is the child of avarice, the brother of inequity, and the father of mischief. This was written by George Washington in 1738. This is a vice which is productive of every possible evil. In a word, few gain by this abominable practice, while thousands are injured. I can't pronounce that word. It's hard for me. Abominable. And yeah, I mean, basically, appreciate it, Well, I appreciate you guys tuning in. If you like what I shared with you and would like to hear more, please subscribe and like. I appreciate you for that, and I appreciate your time. Thank you guys, and I'll talk to you guys soon. Have a great week.